Brandon is 29 years old, and he is precise. Not just competent, precise. His models reconcile down to the last decimal. His assumptions are defensible. His conclusions hold under pressure. When Brandon speaks in meetings, people don't interrupt. Not because they agree, but because they are waiting to understand. Brandon works as a senior analyst at an investment firm that manages just under $5 billion. Not large enough to be famous, large enough to matter. He covers industrials, mid-cap companies doing essential work. Firms that don't trend, but don't disappear. Brandon believes in discipline. He arrives before sunrise, opens his screens, and begins. Earnings reports, transcripts, margins, guidance. He builds conviction slowly, then acts decisively. He believes the market is efficient over time, and when it isn't, he believes his job is to find the gap. That belief has served Brandon well, until it doesn't. The call comes in late afternoon, just before close. Unknown number. Brandon almost ignores it, but he doesn't. The voice is controlled, measured, the kind of voice that assumes access. He introduces himself as Daniel Mercer. He represents a private family office with multi-generational capital and no external investors. They hold a significant position in one of Brandon's core names. 17%. That is not passive. He asks for a meeting, not next week, this week, before earnings. Brandon agrees. The office is understated. No signage, frosted glass, quiet reception. Brandon is led into a room that feels less like a workplace and more like a place where decisions are made. Minimal, intentional. Mercer is already seated. Mid-50s, composed, no visible effort in how he presents himself. He does not stand to impress Brandon, he stands because the meeting has started. A folder sits in front of him. He slides it across the table. Inside are Brandon's last reports, annotated. Not highlighted, annotated. Margins filled with questions, observations, corrections. Someone has been reading Brandon closely, closer than his own team. He feels it immediately, not intimidation, calibration. Mercer begins without preamble. The family acquired this position 11 years ago. Cost basis $180 million. It is now worth just over $1.1 billion. Brandon nods, he knows the numbers. He modeled the upside himself. Mercer watches him and asks a simple question. Why would we sell? Brandon gives a simple answer. Rebalancing, risk management, capital rotation, locking in gains, reallocating to higher return opportunities. He has said this before. It is correct, technically. Mercer leans back slightly, not dismissive, just finished listening. Walk me through the tax, he says. Brandon does. Federal, investment income, state. He estimates roughly $220 million in taxes. Mercer nods. Permanent, he says. Brandon does not respond, because he is right. That is not a cost, Mercer continues, that is a subtraction. Mercer opens the folder again and slides a term sheet toward Brandon. A credit facility, $600 million, secured against the position, fixed at just over 4%. Structured, clean, conservative. No sale, no tax event. Liquidity created, not realized. Mercer watches Brandon's expression shift. Why would we convert an asset into cash, he says, when we can convert it into collateral? Brandon does not answer, because the question changes the frame entirely. Brandon leaves with a document, but more importantly, with a fracture. Not in his knowledge, in his framework. The first year, Brandon observes. He is brought in quietly, not as an employee, not as an advisor, but as a participant. He sees how the portfolio is constructed, not allocated, constructed. Real estate sits inside layered entities, each with a purpose. Liability isolation, tax efficiency, transfer control. Equities are placed into trusts designed for continuity. Private credit generates yield, but more importantly, leverage capacity. Everything has two functions, return and utility. Brandon begins to understand this is not investing, this is architecture. One night, Brandon models it. 2 scenarios. Identical assets, identical returns. In one, the portfolio is actively sold and rebalanced, taxes paid along the way. In the other, assets are held, borrowed against, never liquidated. Brandon runs both forward for decades. The difference is not marginal, it is structural. Hundreds of millions. Not from better investments, from better decisions about when not to act. Brandon sits alone and realizes something uncomfortable. The advantage was never in picking winners. It was in refusing to interrupt them. The wealthy do not sell, Mercer tells Brandon, because selling ends the compounding. In the second year, Brandon is introduced to another family, Older Capital, Infrastructure Holdings. Assets that persist. A toll network, a water system, logistics hubs along critical routes. They generate cash, consistently, indifferent to market sentiment. Brandon sits in on a meeting where an offer is presented. Clean, attractive, immediate liquidity at a premium valuation. The room is quiet. He expects discussion, negotiation, curiosity. Instead, the head of the family asks one question. What does it support? The advisor answers with a borrowing figure. There is a pause. That is sufficient, he says. The meeting ends. No sale. No hesitation. Brandon understands they are not evaluating price, they are evaluating function. Cash is temporary, Mercer tells Brandon later, assets are continuous. By the third year, Brandon is building. A founder arrives with most of his net worth in a single position. Valuable but illiquid. Selling would collapse the price and trigger a massive tax event. Brandon designs a solution. Complex, expensive, but effective. The position is placed into a structure that allows diversification without sale, tax-deferred, liquidity access through borrowing. When it closes, the founder calls Brandon and says he did not know this was possible. Most people do not. That is the point. Brandon begins to see risk differently. Not volatility, but fragility. How easily something can be broken by a single decision. Selling, he realizes, is often that decision. Assets begin to look different to Brandon. Not as positions, but as nodes. Each one connected, each one supporting the others. A property generates income, that income supports debt, that debt funds acquisition, that acquisition becomes collateral. The system expands structurally. Brandon understands you do not remove pieces from a system like that, because removing one weakens all. In the fourth year, Brandon is brought into a defensive situation. A public company under activist pressure to sell assets and unlock value. The logic is clean, the same logic Brandon once used. But it ignores structure. The assets generate income, control, leverage capacity. Selling would create cash and destroy everything else. Brandon helps design a response that provides partial liquidity without full divestment. The activist exits. The assets remain. Value is not what something sells for, Mercer tells Brandon, it is what it continues to produce. Brandon sees the pattern clearly now. Selling is final. Holding is flexible. Selling triggers tax. Holding enables strategy. Selling creates cash. Holding creates options. Brandon returns to his models. They still work, they are still accurate, they are just incomplete. Because they assume the objective is return. It is not. The objective is endurance. Years pass and Brandon's role changes. His network narrows. He is brought into decisions that are not just financial, but generational. A large position, massive embedded gain, a potential sale. The numbers are clear. The tax would be significant and irreversible. Brandon sits in the room as options are discussed. Sell, borrow, restructure, delay. Brandon notices something. No one asks what the return is. They ask what do we lose. Because that is the real calculation. Not upside, subtraction. Brandon thinks back to that first meeting. Why not sell? He understands now. Because selling is easy. Anyone can do it. Holding correctly, deliberately, structurally, that is where the discipline is. That is where the advantage lives. Brandon no longer thinks in trades. He thinks in systems. He no longer chases returns. He protects compounding. He no longer asks what an asset is worth. He asks what it does. And once Brandon sees it, once he understands that wealth is not built by what you buy but by what you refuse to give up, he cannot unsee it. The market will open again. Prices will move. People will buy. People will sell. And somewhere, quietly and deliberately, Brandon knows someone will do nothing at all and become wealthier because of it.